was I'd heard this story that Fidelity had done a study to see which of their clients performed the best. And it turned out it was the dead clients. These people who'd created a trust and who basically didn't fiddle with the portfolio, and their portfolios just blew all the others out of the water. So I'd heard that it was Jim that came up with this anecdote, and he confirmed that he'd heard it from someone at Fidelity. They never found the original reference, but I think the idea is a good one, which is don't fiddle. The ideal investor is a dead investor. So if you can pretend to be dead, then that's a good way to do it.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi Freedom Fighters. How active are you as an investor? How often do you touch, change or play with your investments? How often do you buy or sell? Do you believe you need to be an active investor to make money? Do you think that the more active you are, the more money you'll make? That to be a successful investor, you need to constantly make it happen, not let it happen. If you believe this to be the case, then you're not lonely. Most of us suffer the misapprehension that the more active we are, the better we are. And this applies to just about anything and everything. But does it really apply to investment success? To give you the surprising answer to this critical question, I'm going to draw directly on some of the fantastic work that's been done by today's special guest, Ramin Nakisa, who produces some fantastic educational and informative YouTube videos and courses on all things equity investing. But more on Ramin later. Is your investment success dependent on how active you are as an investor? This is the battle between active and passive, between buy and sell constantly versus buy and hold or set and forget long term. Well, the answer is bound to surprise you. As Ramin mentioned in the episode opening, the ideal investor is a dead investor. Or if not dead, then at least forgetful. Forgetful of the fact that you've even invested. Let's dive into this a little deeper. According to American investment legend James O'Shaughnessy, and quoted in a 2014 article in Business Insider, if you want to be an above-average investor, it may pay to play dead. Apparently, that was the conclusion of a study by US fund manager Fidelity, where Fidelity analysed thousands of client accounts and broke them down into percentiles, trying to figure out what the top performers had in common. And the result? The best investors were either dead or had forgotten they even had an account. And plenty of other research comes to the same conclusion. Investment activity is the assassin of your returns. A University of California study of 66,000 investors found that the higher an investment portfolio's turnover, the lower the average return. Those who traded and changed the most lagged the overall market's performance by 6.5%. Now that's massive over time. And as the researchers put it, active trading is hazardous to your wealth. And their conclusion on the reason is pretty simple. Impatience adds what they call frictional costs. For anyone who shuns a buy and hold philosophy, brokerage fees and taxes quickly bite into their returns. The nature of compounding means that small disadvantages in any one year that may seem trivial at the time can take a big chunk out of your final payout. Curiously, the University of California study also found that high turnover correlated with underperformance and led the researchers to suggest that the culprit may also be mental. In particular, our overconfidence. We tend to overestimate our own abilities. Our confidence in our predictions is generally greater than their accuracy. This is then exaggerated by another cognitive mishap called confirmation bias. Once we form an opinion, we tend to search for and interpret information in a way that's consistent with it. Overconfident investors will overestimate the value of their private information, causing them to trade too actively, the researchers suggest. Overconfidence can cause you to buy and sell at the wrong time, and then mistakes and frictional costs then pile up. Another study conducted a few years back by Dalbar Institute showed that investors receive 3% less per year than the US S&P 500 index generated over a 10-year period. And the average holding period for a typical investor was just 6 months. Just 6 months. Now, in my humble opinion, when you hold an investment for less than a year, you're not really investing. Instead, you're just guessing at short-term news and expectations, and your returns are based on how other people react to that news information. In other words, you're speculating or gambling. And the results are in. That kind of attitude gets you 3% less per year than you'd get from doing nothing at all beyond making an initial investment in an index fund that mirrors the overall market. And there lies the secret. So, how can you play dead when you invest? Firstly, focus on the long term and ignore the short-term noise. If you're investing for the next 10 or 20 years in a good quality asset, try to ignore short-term value movements, because whether your investments go up or down 3% today just doesn't matter. Secondly, take your time and play your own devil's advocate. Feeling that you need to act on advice immediately is a big no-no. The business news is specifically designed to get you excited so that you continue reading. And the more news you consume, the more likely that your confirmation bias and your overconfidence will lead you to trade too much. Before selling, sleep on your decision for a few days and try to think of the counter-arguments to your investment case. So when in doubt, do nothing. And here's a suggestion. Practice diversification and don't micromanage. Perhaps the best way to counter overconfidence is to always leave a margin of safety between the price you pay and the intrinsic value of your investment to allow for mistakes. If you invest in a collection of good assets, bought when they're undervalued, and then you hold them for the long term, history shows that you're bound to do well. As the world's most successful living investor Warren Buffett says, the biggest thing about making money is time. You don't have to be particularly smart. You just have to be patient. Now, over the years, I've seen that active investors tend to trade a lot in general, chasing what's hot and selling what's not. And at the end of the day, they end up consistently buying high and selling low, which turns out to be really costly for long-term returns. If you're an active investor, your portfolio starts to look like a bar of soap. In other words, the more you handle it, the smaller it gets. And this goes to further reinforce that what may appear as lazy set and forget investing isn't sexy, but it actually works. Now, these are certainly not the first studies to show that lazy portfolios work. Over time, Slow and steady seem to win the race when it comes to investing. While active investors will tell you it's possible to time the market and make a killing, the data actually shows otherwise. And the good news is that set and forget investing has been consistently proven to be the easiest and safest bet for investors. So what's the biggest take-home message in all of this? The biggest impediment to your investment success is you. How you think, how you feel, and how you behave. And most of these are driven by our inherent inbuilt evolutionary psychological biases. The more you worry about your investments and get actively involved trying to buy at the bottom and sell at the top, the more likely you are to seriously hamstring your investment results. So, what's the easiest way to turn this around? Invest wisely and then get the hell out of your own way and let time, the tax office and capital growth work their magic. Spend your time up front and early doing your due diligence on what to invest in and how, in alignment with how much time and money you have to spend and what your risk tolerance is, and then get out of the way and let your investments do their work, while you get on with investing in your career and spending your limited free time with your family and friends. Don't create a second job when you invest. In other words, KISS. Keep it simple, stupid. Now, this is easy to say, but what does this mean in real terms? What investment strategies and approaches should you adopt? Well, to whet your appetite on this for the equities and bonds portion of your investment portfolio, let's draw on more of the great work from today's guest, Ramin Nakisa, who has some great YouTube videos and some courses designed so that you can make more informed investment decisions. And before we jump into it, let's reinforce that nothing we are talking about today is a recommendation, nor is intended or should be interpreted in any way as financial advice. Before you employ any of the suggestions or topics covered today, please seek independent financial advice tailored to your specific needs and circumstances. Now, as Ramin clearly states, investment is a journey, and the strategies that you use when you start out are likely to be very different to the ones that you use after many years of investing. So, in this excerpt, we look at 4 proven strategies that will see you through your investment career. Now, your investment journey over the long haul is a bit like learning to drive a car or flying a plane. So cast your mind back to the time you learned how to drive. Did you just jump straight into a Formula One supercar? Or how about pilots? Do you think they learned how to fly at the controls of a commercial airliner from day one? No, of course they didn't. The way we learn is to start off simple and then build up complexity as we go along. It's just a more natural way to learn. And that's why it's still very surprising that you see so many books and videos that say you should just jump straight into single stock picking investing from day one. That's very risky, and it's very likely to underperform compared to just buying a global market index. And remember that even professional investors fail to beat the market about 80% of the time. And they've got huge resources behind them with full research departments, and they can almost spend 24 hours a day looking at investments because that's their job. Trying to choose single stocks which outperform when you're just starting to invest is kind of like watching a few YouTube videos and hoping you're going to become a neurosurgeon. So if you're getting started, there's a really simple way to do that, and that's by buying just one fund. What's good about that is that it limits the biggest risk to your investments, which is your own personal behaviour. If you only have one fund, then you only have 2 choices. You can either buy more of that fund, or you can sell some of the fund that you already own. And for long-term investment success, all you have to do is not sell until you need the money, preferably after decades of investment. So when you buy a fund, intend to hold it for a very long period of time and let markets work their magic. The kind of fund you'll need to do that is a multi-asset fund which contains both bonds and equity. Now, one example of that is life strategy funds produced by the likes of Vanguard. But what's really important to understand is the level of risk, which is determined by how much of your portfolio is made up by shares and equities versus bonds, as well as how long your investment horizon is. In simple terms, the higher your risk appetite, the higher the portion of shares and equities in your index mix. And if your investment horizon is long, you can afford to dial up the risk to a higher level, and that's by having more shares and stocks in your equities portfolio. So the percentage of shares in the fund can go from 0 to 20 to 40 to 60 to 80%, and if you want a 100% equity fund, you can just buy global equity tracker funds. And then you just need to consider the risk-reward trade-off, with 20% equity having lower risk, but also lower reward over the long term. And also, this is suitable for shorter-term investments. And as you dial up the risk, then a longer investment horizon would be more appropriate. But the compensation for that higher risk is potentially higher reward, which you'll more likely get if you invest for 10 years or more. And there are many cheap choices out there to allow you to have a single fund and to invest as simply as possible when you're starting out, or if you're very time poor and just don't have the time or knowledge, or in fact the need, to do anything more than this. The next level investing complexity that Ramin discusses is to have two low expense funds, a Global's equities fund and a bond fund, which is the approach that Ramin personally adopts, and remember, he's a very sophisticated investor with years of experience. For the global stock part of the portfolio, Ramin uses an example of a Vanguard fund which tracks both foreign and US stocks and includes both developed and emerging markets to diversify the risk. Now, in his detailed YouTube video on this, titled Investing Strategies for Beginners to Advanced, Ramin constructs 6 portfolios. And in these, he progressively dials up the amount of equity from 0% all the way up to 100% for the riskiest portfolio. And as you'd probably expect, with the lowest risk zero equity portfolio, the price doesn't fluctuate much. It's fairly steady line. But what you also see is that over a long period of time, it's the one that performs the worst. Whereas the 100% equity portfolio fluctuates wildly, and it loses a huge amount of money during the global financial crisis, for example, about half of its value in fact, but then it recovers very quickly and goes on to outperform all of the other 5 portfolios. Now, during this period of time, you probably would have had to rebalance your 2-fund portfolio. So, say you started out with a 60% equity fund and 40% in bonds fund. After a steep fall in the equity market, the actual proportion of your portfolio, which is in equity, would have fallen. So you'd have to have sold a bit of your bond fund and bought more of your equity at the lower price. And that's why a 2-fund portfolio takes more maintenance than a single multi-asset portfolio, because you have to do the rebalancing yourself. Now, over a 15-year period, Ramin's example portfolios show that you'd have made about 4% with a 100% equity portfolio every year, whereas with a 100% bond portfolio, you'd have only made about 1.5% per year. But the risk would have been much lower. Now, your choice of risk really depends on your risk appetite and the length of your investment horizon, but also your risk capacity, which is how much of a loss you can afford to make without affecting your quality of life. His example clearly shows the risk-reward trade-off, in that if you're willing to take more risk by having more equity in your portfolio and less bonds, you have a much greater probability of getting a better return long term. Now, once you've been investing for a while, the next third level you may decide to switch to is something which is called, by Ramin, a core satellite investment model. Now, the idea here is that at the core is a really safe, globally diversified asset class at the core of your investments. And the core is usually low fee and consists of passive funds. Now, for the excitement of some of you that are looking for it, the perceived drawback with this is that it's boring. Now, if you may want to invest in stuff which is a bit more exciting and which you think is going to give you better returns, and whether you're right about that is another matter, but good, successful investment is generally extremely boring and akin to watching grass grow or paint dry. But hey, if you're one of those that think that investment should be a little bit more fun, then alongside your diversified cheap core portfolio, you can incorporate something a little bit more exciting. Maybe something risky that makes up a small portion of your portfolio, so that if things do go wrong, and they often do with new and trendy fat investments, it's not going to be a disaster, but it can add a little bit of spice and a bit more engagement to your portfolio. So, what could that satellite investment be? Well, perhaps some kind of thematic investment. You might believe in a narrative that robots are cheaper as a workforce and they're also more productive than humans. So you could choose to invest in companies which produce those robots. And that way, you could make money from that long-term trend in the workplace. But be warned, the drawback with thematic investing is that it can be more expensive in terms of expense ratios, often double the cost of diversified global funds, which can seriously eat into your profits long term. And new and unproven industries and technologies can be very volatile, and your emotional interest and attachment can lead you to make knee-jerk buy and sell decisions that hamstring your long-term results. So yes, investing in areas of belief can be more fun, and you can engage with a particular theme with which you feel a connection. But just bear in mind this shouldn't be too much of a large proportion of your portfolio, because these narratives often turn around quickly and start to underperform. But you can rely on the core of your portfolio to drag your returns in the upwards direction over the long term. Finally, the most complicated strategy that Ramin discusses is constructing a portfolio which uses detailed asset allocation, which is much more active, much more complicated, much more time-consuming, much riskier, and not necessarily any more profitable. It's kind of like the inside of a watch. There's lots of independent moving parts, and it's very difficult to make sense of it. And that's because now you could have dozens of funds. So just in the equity part, you can have many different components. There could be the US market, Japan, other emerging markets, and all of these would have a separate fund which tracks that region. And then for government bonds, you'd also have regional allocations according to where you think yield curves are going to be, but also which regions are going to give you the best returns. And you'd also want to consider things like central bank policy, which affects bond returns. Or maybe you want to diversify by having different asset types, maybe real estate investment trusts. And again, there you can have regional real estate investment trusts. Or you could break it down by sectors. Or perhaps you want commodities like gold and silver, which are quite popular. But you may consider others, such as oil or even agricultural products, because these could further diversify your portfolio. But all of them are driven by different factors. So that makes it very difficult to keep on top of all of the different changes over time. So in summary, it's probably best to start simple, in line with your level of knowledge and the time you have available, and then maybe make your investments more complicated as time goes on. But remember that even Ramin just uses 2 to 3 funds in his portfolio because he knows that it's important to keep things as simple as possible. And having more complexity doesn't necessarily improve your long-term returns. It just improves the chances of making investment errors, because your success is relying more on you, and you are your nest egg's biggest risk. As I discuss in my book, The Freedom Formula, if your high-performance investment cycle is the vehicle that will get you to your net wealth destination in the quickest, safest and easiest fashion, then you need to assemble your investment gear set. In bike terms, your gear set is a set of gears for transmitting motion for a specific purpose. So you need to choose the best available gear assembly that will easily transmit the power of your upward progress. So trying to ride a bike up a steep hill is pointless if you're stuck in top gear and simply don't have the power and the energy to keep the wheels turning. So against this gear set measuring stick, as a time-poor, career-focused professional, anything that you invest in must be G for growth-focused, offering high asset growth over the shortest possible time frame, E for easy to implement, A for affordable, being low cost to establish and affordable ongoing. R is for risk averse, because what you invest in must sit comfortably within your sleep at night factor. S is for simple and quick to understand. E is for equity low, so that you use as little of your money and or deposit as possible to secure the asset. And finally, and most importantly, T is for time efficient and effective. So it doesn't require much of your time to acquire, manage or monitor, and doesn't create a second part-time job. For example, it should only require an hour a month plus 2 or 3 hours a year to monitor. Anything you decide to invest in and the way you invest in it needs to satisfy these GEARSET gear set criteria. That is simple and easy, time effective, low cost, and high growth. Meaning you just need to pick investment vehicles that tick these boxes and the job's done. So keep it simple, because remember, to be a successful investor, you're better off dead. Now, if you really want to learn about the importance of asset allocation and risk management at any level of complexity and how important this is to your investment success, Ramin has created a great series of courses for you to get invested in your knowledge as the first step to investing safely, easily, and affordably in your future. And Ramin is generously offering you, as a Get Invested listener, a very special time-limited offer. He's offering you a 10% discount on his DIY asset allocation course, which expires at midnight on the 31st of December 2021. To take advantage of his awesome asset allocation course, which is the most comprehensive course his company offers, that takes you from an absolute beginner to a pretty advanced investor level, and also includes 2 one-hour one-on-one sessions personally with Ramin via Zoom, where you can either discuss the course or any investment topic, such as building or even getting feedback on your own portfolio. So just register at PensionCraft.com/register/DIY asset allocation course using the special coupon Bushy2021, or just click the link in the show notes. But don't forget to use the Bushy2021 coupon to get your discount. And Ramin discusses more about asset allocation in our great chat today. So by way of background, Ramin Nakisa is a UK-based investment coach, author and founder of PensionCraft. Ramin worked in investment banking for over 15 years before becoming a strategist, where he spent 2 years teaching finance in an investment bank, which was a big passion of his and also helped him to learn how to explain finance in a non-mathematical way, which you'll really benefit from in our discussion today. Ramin's also written 2 books about finance and investment: A Financial Bestiary, which is written for professional investors, and Invest in Fear, which explains how to buy and sell volatility using exchange-traded products, which we actually expand on during our great chat today. Now, Ramin was born and grew up in Worcester. He did a physics degree and doctorate at the Imperial College in London, and then did postdoc research in neural network models of language acquisition in the Experimental Psychology Department at Oxford University. So a really diverse and really interesting background. And in our fascinating discussion today, you'll be fast-tracked and equipped to be a better investor, as Ramin also reveals why he's the David Attenborough of investors, the importance of correlation and diversification. You'll learn who's the biggest risk to your investing success, whether you should invest now or hold during our current interesting times. He gives you his thoughts on cryptocurrency, and we talk about the impact of fees on investment returns, and you'll really enjoy his hilarious feeding the pigs investment analogy, so listen out for that one. Now, what I really like about Ramin is that if you want to learn to be a better investor, he isn't going to give you financial advice or push products, but he'll teach you what you need to know so that you can make up your own mind. And to help you do this, his company PensionCraft offers online one-to-one coaching in his power hours, as well as the online courses that I've already mentioned. So take the next step with Ramin at PensionCraft.com, where you can also subscribe for market insights. And as you continue to upskill as an investor, make sure you join me for our unique Know-How Property Freedom Flight program, where I'll guide you through my proven process for property investment success. So to book your ticket for that, or to find out more, just click the link in the show notes at knowhowproperty.com.au/Freedom Fighters, or visit knowhowproperty.com.au. And while you're better off playing dead or being forgetful to become a successful investor, you're much better off being alive today as you enjoy this engaging and really informative chat with Ramin Nakisa.
Hi, Freedom Fighters. Now, in my continual search for quality investment information from quality investment people to inform you here on Get Invested, I rarely come across someone who's not only really good at what they do, but also communicates objective, independent insights in a easily digestible, understandable, and quite humble way. But this is exactly the case with today's special guest, Ramin Nakisa. Now, I've been quietly listening to his very informative and timely YouTube segments for some time now, and both excited and quite humbled to be able to share his wealth of wisdom with you here today on Get Invested. So welcome, and let's get invested, Ramin.
Thank you, Bushy. That's really kind of you. So do you want me to just explain what I do?
Yeah, so to start off, for those who haven't had the pleasure of enjoying you on your YouTube channel, just give us a rundown on who you are, what you do, but most importantly, why you do what you do, Ramin.
Well, I think the reason why I do what I do is because I used to work in the investment banking industry. And if you work within that culture, there's a lot of assumed knowledge. So there's a lot of jargon that we use. There's a lot of knowledge that we have. And of course, in any kind of discipline, you have this kind of shorthand which you use, and people just assume a certain amount of knowledge. So what really struck me is when I left that world is how little other people understood about investing and how to succeed in investing. So really my goal was to allow people who haven't had that investment banking background to understand how they can succeed in that space, in the investment space, because I think the knowledge just isn't there. We aren't taught at school how to invest, which is really awful, I think. You know, they teach you all kinds of things which are really not very useful at all. I left school with lots of knowledge of things like Latin and physics, but when it came to investing, I knew absolutely nothing. So I had to literally teach myself. I had to bootstrap myself into the industry. And so I thought if I provided a resource for people to be able to do that themselves, that would be quite valuable. And certainly that's the way it's turned out, I think.
Now, I think you've touched on a very good point. It's exactly the same here in Australia, clearly as it is in the UK. And I actually think it's actually worse than what we think, because not only are you not equipped financially or investment-wise to really look after yourself, but unfortunately the education system, if you're not good at maths, then they carry this chip on their shoulder for the rest of their life about this fear of money and this fear of finances. Is that been your experience in the UK?
Yeah, and what really struck me was that you didn't need to be good at maths or even intelligent to do well at investing. I think it's more to do with discipline than it is about being smart, and really self-control and having that kind of long-range approach to investing and really keeping at it for a long period of time. And that takes huge discipline. Whereas, you can be really clever and come up with smart ways to trade, but ultimately those won't succeed unless you've got the kind of mental fortitude to stick at it year after year.
Yeah, mental fortitude is an absolute key one. There's no doubt about that. Okay, so what I'd love to do, if you wouldn't mind, is share your journey with the listeners, going back as far as you are comfortable and as far as you can remember, and talk us through what you've invested your time, energy and money in, what you've learned from that, what were some of the wins and losses along that journey, and how that's brought you back to what you're now doing.
Yeah, sure. I guess what some people might find surprising was that my first love was physics. I absolutely love physics, and I kind of lived for physics. I lived and breathed it. I did a degree in physics and a doctorate as well. So that was my kind of goal for life, I thought. But then, I got to the point where I got married and I decided that I wanted to be able to afford a house, and academia just wasn't able to pay for some of those things. So I left academia and I started working on the business side. And initially I started modeling human behavior. So me and my team, we were working on Bayesian models that would predict customer behavior. So a lot of companies wanted to use this kind of thing for marketing. So obviously nowadays they call it big data, but we were just using some fairly simple models to try and see whether people would leave a bank or whether they'd buy a certain product, when it was worth marketing something, and whether you could kind of nudge people into buying certain things or not, and the cost required in order to do that, in order to make it worthwhile. So that was the kind of thing we were working on, which was really interesting. And then I worked for a while just kind of freelancing. So I helped companies do some of these mathematical problems. And then eventually I had my first child. So I got married. We had our first child. And at that point, I needed something more solid. So I went to see this recruitment agent and he said, well, you're good at maths. Why don't you work in investment banking? So off I go to this investment bank. Day 2, I see the Twin Towers. An aircraft plows into one of the Twin Towers. And I think, what the hell have I done? So it was a bit of a baptism of fire. But I did meet some really interesting people. And initially, I was pushed into the kind of tech space. So I was working on risk systems at an investment bank. And they said, right, you can do maths. So you work on this system modeling risk for us. So that's what I did. And, I made some interesting friends there. There was a guy who created one of these risk systems, and we made friends. And he was really interesting, actually. He kind of learnt Farsi, which is, I'm half Iranian. So he could speak Farsi, even though he's English. And he always used to make fun of the management at this bank. And it was a French bank where they take things very seriously. So it was great fun. And we used to talk about maths, and we used to go out for Persian food. It was great. So I did meet some really interesting people. And I realized that actually being part of a tech team was not what I wanted to do. If you're the only PhD in the group, you start to think, well, why is that? So after that, I moved into a kind of more kind of banky type of job rather than a tech job. So this was more of a quant role where I used my math skills better and I was better paid. So there was an entire team of people, all of whom had PhDs, and we just had an absolute blast. This was another risk system, but I was kind of moving up into the more core part of the investment business. And then I was there for about 2 or 3 years, and I was learning a hell of a lot about all of the assets that we were pricing. And I was right in the middle of the credit bubble. So I was working on the risk systems, which were involved in pricing some of these things like CDOs and another asset class called ABS, which also imploded during the during the global financial crisis. So I was really kind of in the middle of it, and it was just a wonderful environment in terms of ideas, in terms of fun. We used to have a lot of laughs in the role. But, that eventually I kind of got pissed off with that role because it wasn't a client-facing role. And if you are in the kind of middle office in an investment bank, you just don't get the big bucks. So for me, it was important to try and move to the front office. And also, I think to use some of the more kind of skills that I learned in teaching. So what I did is I moved to a role where I was actually teaching within the investment bank. So they actually have a group which teaches how to price all of the assets that we have, or they actually teach clients and they teach staff. So it was like a business university, they called it. And that was brilliant. I absolutely love that. So that was a big move for me because it meant that I could learn about every single asset that we traded. I would talk to traders, I talked to salespeople, and I trained them. So it got to the point where I could walk along the trading floor, and I taught a lot of the grads, and they'd all say, "Hi, Ramin, hi," and it was quite a kind of collegiate atmosphere, which I absolutely loved. Yeah. And but it forced me to learn absolutely everything and exactly how to price everything in incredible detail, and that was important because you couldn't, if you stand in front of a group of traders teaching them about derivatives for 2 weeks for 7 hours a day, if you get something wrong, they are absolutely ruthless. And so that was a great way to learn. But the way we did it was I'd sit in on 2 classes, and then the next class I'd be teaching it. So that was a real baptism of fire. But what was interesting about it was that the way we taught was not mathematical. So if you, for example, if you price a derivative, you might think it's all about maths. That's not true. With any product that an investment bank prices, it's as if, they hand you a folder and they say, look, a client's just bought this product. How do we hedge the risk? So literally, you go through this folder page by page. So first of all, we lay off the equity risk by taking opposite position. Secondly, we lay off the interest rate risk by taking this interest rate derivative. So then the ultimate cost to the client is the cost of hedging their position. So that's how you price things. It's not to do with maths, really. It's the cost to the bank of hedging, plus you add a bit of extra money, which pays for your Lambo or whatever it is. That's how the banks make their money. Yeah, so that non-mathematical approach to teaching was something I learned there. And it was an incredible team that used to teach there at the investment bank. So that was very useful, as it turned out later on. Of course, you never know what's going to be useful at the time. I didn't know physics would be useful later on, but it was. And I didn't know that the kind of teaching skills would be useful either, but it was very useful later on. Yeah, as it is now, of course.
Of course. Yeah, of course. So and that's something I'm interested in because what I'm picking up from what you're talking about already is that you have a natural leaning towards teaching. That's something that you're clearly very comfortable in and very good at, given what you're now doing on YouTube. The physics attraction early on, where did that come from? Can you remember?
I can actually, because as a kid, I grew up in, when I was very young, I grew up in Iran, and they used to have really clear nights if you go out to the desert. And I was just completely captivated by the stars. And I just thought, that is the most incredible thing. What the hell are they? So I wanted to learn about astronomy, and astronomy was what I thought I'd end up doing. So I thought astrophysics would be the way to do that. As it turned out, my PhD was in biophysics because I got kind of interested in how physics can be applied to understanding how living things work. So that was kind of like the original goal was astrophysics. And I still love astronomy. So, if I go out into the night sky, I can name the stars. And, I used to do a bit of astrophotography. That was great fun. So that was how it led to physics. It was via astronomy.
Right. Yeah, love it. You clearly you've got quite a a structured mind. I always saw physics as something that's reasonably structured and fairly logical. This goes with that. If you follow it through and break it down small enough, then you can sort of start to put the bigger picture together. And it was that sort of thinking approach. And it's quite lateral, but also quite logical at the same time. Was that something that was quite transferable and quite useful to you and what you were then doing in the investment space?
Very much so. And that's why I think there are so many maths and physics PhDs in finance. So a lot of the products that you come up with have been thought up by physicists. I mean, that's good and bad, right? Because some of the products clearly haven't survived the test of time, but many of them have. And if the clients want something, then your job is to produce a product which suits their requirements. And often that blows up because they don't understand the risk or you don't understand the risk eventually. But I think that innovation and that mindset was useful later on. And certainly the way you kind of break down a problem and do something in a pragmatic way, which seems insuperable at first. So something like pricing a CDO or something complex seems almost impossible, but breaking it down, it becomes almost beautiful. And although these things did blow up, I'm sure that the maths is so lovely that they'll probably come back in some form. I do see them coming back now. I do see some CDOs are starting to be sold again. But that kind of idea of tiering risk and layering risk and parceling up risk and buying and selling it, certainly that, I think, comes straight out of the canon from physics and mathematics, clearly.
Yes, clearly, yeah. Okay, so the good thing is that given that you sort of transitioned through that space, you pretty much had exposure to all and every aspect, and because you've had to teach it. I mean, there's no better way to learn something than to have to teach it. I've always found, and I often say to people, if you want to learn something, when you're learning it, think to yourself, I'm going to have to teach someone else this. And as soon as you do that, you'll be much more focused about not only taking on board what you're hearing, but then thinking about how am I going to then translate this and communicate this effectively to someone else that hasn't had the benefit of learning. Has that been useful to you in terms of building that skill base that's now so effective with what you're doing?
Absolutely. I mean, I think another good way to do it is to write down what your understanding is. If anything, you can write a book about it. And in fact, the first book I wrote was written on the tube. So, every morning I'd be on the 5:30 train amongst all the builders working traveling into the city. And it would be like the milk train. It would be so early that, everyone would be asleep as I left and everyone would be asleep as I came home. But I'd write 2 hours a day because I was commuting on that train. So I'd be in there squeezed amongst the builders, writing all these equations into this book. But ultimately, it meant that I could understand the products that we traded. And I wrote this book called The Financial Bestiary, where I kind of treated it like animals at the zoo. A bestiary is like a medieval book where they talk about the different types of animals. And the idea was that you'd learn a moral from each of the different animals. So this is the salamander, and it teaches you about moral courage. This is a dragon, and so on. So I did the same thing. So my beasts were the people who worked at the bank. So I got pictures of the people I worked with. And I say, this is a trader. This is what they do. This is a salesperson. This is what they do. And this is a structurer, a risk guy, all the different roles at the bank. And then also the products that we treated them like animals. And I think that's a good way to understand how investment works, because you can almost think of the different asset types as creatures, as animals. And I think the job of an investor is to understand the nature of each animal. And this is why I was asking you about naturalists in Australia, because David Attenborough, I see myself as a kind of David Attenborough, but for investment. So I can say, here are the asset types. These are the environments in which they live. Some assets do well in this kind of environment, this kind of macro backdrop. Some assets do well in another type of environment. And each of the different asset types evolves into its own niche. And there's a continual process of evolution. So, as I say, the job of the structurers, the investment banks, is to come up with the new organisms, the new products. And then ultimately these go out into the world and they're kind of tested in markets. Some of them survive, some of them don't. Sometimes you get a merger of different types of product into one. And then over time, you come up with a process of evolution and products which are robust and which have lived through multiple cycles of extinction. So after 2008, we saw many of the products that were created stop existing, but many of them have gone on and kind of shown they were incredibly robust. Things like ETFs, which people thought were about to kind of collapse the financial system, or some people have said they're akin to communism. But in fact, they've been incredibly robust and they've survived multiple crises and not caused systemic problems as people thought they would. So I think that's the way I see investment, kind of almost like a naturalist.
Yeah, I love it, because what it's recognising it's a dynamic system of changing and evolving parts. And I'd love for you, we'll get to it shortly, but I'd love you to put some animation around some of that when we start talking about, where you're seeing things now, where it's heading, and put into the bestiary terms. But when you mention bestiary, I go straight to Monty Python, and because I'm an old same age now, but the way they used to carve up the show, that almost had that bestiary type of illustrations and the medieval type of approach of actually communicating it. So it's a very good way of actually, understanding the exercise, but more importantly for those that are listening, starting to see investment markets not as the numbers exercise, but as a living, breathing organism, effectively, or a system of organisms like the Earth. So we have the great meteor crash that wipes out the dinosaurs, and then humans start to take ascendancy over time. It's exactly the same as what you're saying in that regard, as far as the financial markets are concerned.
Yeah, and I think, if we're going to touch on asset allocation, which is what I was doing. So when I became a strategist at the investment bank, the role of the strategist is to advise the people who actually invest your money. So these would be your pension manager, would read research, which is produced by investment banks, and they get ideas from us. So that was the idea, that we would publish research that would be given to clients. And if they liked our research, they trade with the banks. So that was the kind of understood quid pro quo. And if they did like the research and the ideas, then obviously they come back for more. So the role was to come up with the idea generation, and some of the stuff I did was to do with asset allocation. So it's how the animals live together. So when you construct a portfolio, think of that almost like a living thing, where you have to kind of create an ecosystem where the assets live together in harmony. Now, obviously, just as with a kind of ecosystem, if you have too much of one organism, so for example, I believe in Australia there was a plague of rabbits. Those were introduced, and then there were too many of them, so they brought in another species in order to kill them, and then there was an unstable population spurt in the predators. And so I think a portfolio is similar. You've got to achieve that balance. So I think that's why it's really important to understand things like correlation, because that tells you whether two assets sit nicely together, and if one of them counteracts the risk from the other. So if you you could think of lots of predators inside a room. That's like having a portfolio which is 100% equity. Or if you have lots of things which are in a room which essentially eat the same thing, then that's risky because they could run out of food. So that's why I think it's important to have a diversification across different asset types in your portfolio, because under different types of conditions, you'll find that some of them do well. And then as conditions change, you want to make sure that your portfolio will do fairly well in all of those conditions. This is the kind of thinking behind portfolios like Ray Dalio's all-weather portfolio, for example, where you've got some gold, you've got some fixed income, some of it is short duration fixed income, some of it's long duration, you've got some equity, and in each kind of environment, some of those asset types will do better. So if you've got deflation, the bonds will do well, the equities not well. and the gold probably would be okay. If you've got a very strong growth environment, then the equity will do well. So in every kind of environment, something will do well. So this is why I think that kind of analogy is a good one for building a portfolio, and asset allocation as husbandry almost.
Yeah, I love it. It's a great analogy and a great way to put some perspective around it, and to take some of the fear out of it as well. The biggest hurdle I see with a lot of would-be investors is this fear factor over, I don't understand you, this is all too complicated for me. But if you break it down into a simple terms the way you've just done and create things out of it and think about it as an ecosystem, all of a sudden it's like, okay, this is making sense. We don't want all of one thing because they'll end up eating each other. If we've got a spread that thrives or survives in different environments at different times, then that's all we need to be doing with what we're doing in the investment space. So that's brilliant. Okay, so you got into asset allocation now, and I want to circle back to asset allocation later and sort of break that down a little bit because I think it's a really important takeaway for listeners, given your expertise in that area. Where did things go from there, Ramin?
Well, there was a kind of change of management at the bank, and I didn't get on so well with the new management at the bank. So eventually they let me go. So I've been at the bank for a long time, so I got a fairly good payoff. And I was, every investment bank person has an exit plan because it's kind of like being in the Second World War. You don't want to get too matey with your friends because they often just disappear. So I was one of the ones that disappeared, and suddenly I was blinking in the sunshine, and fortunately I had a plan. And so that's how PensionCraft was born. I wanted to teach people how to invest. I learned the skills about how to teach at the bank. I had huge product knowledge. So it was a matter of actually simplifying it and making it comprehensible to people who we call retail investors, who are normal people. So you've got institutional investors who are the people, normal people. But it was people who didn't have that shared culture, who were outside the culture. And so it was very difficult at first because I'd lost all of my resources. I didn't have my Bloomberg terminal, and that was a terrible loss. I missed my colleagues, but I missed my Bloomberg terminal more. It was like information was suddenly snatched away from me. And so I was left with...
How long ago was this, by the way?
This was 2017, I think I started.
Yeah.
So, I had to kind of basically start from scratch. So I did that. And one of my colleagues from the bank came with me, who was actually one of the people I worked with in Hyderabad in India. And we started it together. Since then, he's gone his own way, but that's another part of the story. But it was all amicable and it was fine. But for a long time, it just got nowhere. So I had to fall back on tutoring to pay for things like food. So obviously, I'd saved a lot of money and I had a payoff from the bank. And so that could pay for the everyday stuff, but I had to make an income. So literally, I'd spend the mornings and during the day preparing content for YouTube and PensionCraft. And then in the evenings, I'd be teaching physics and maths to students, which I absolutely loved. I really enjoyed that, but it was very draining. And, I was literally working weekends because that's when the kids wanted to learn. And then during the week, I'd be doing the content and stuff for PensionCraft. So it was pretty tough in terms of time. And, I found it quite difficult to kind of schedule everything at the same time. And you have to kind of switch between two jobs, which is very difficult. It's very difficult. If you're teaching someone who's 18 maths to get them through their exam, it's very different to talking to someone about how to invest their inheritance from their grandmother. It's kind of a different mental state, I'd say.
Very, very draining, I would have thought, both mentally, emotionally, and physically over time.
Yeah, it was a very difficult time and very exhausting, I think. And it obviously took a toll on me and my family life. And ultimately, my wife decided that she didn't want to be part of that. And that was a very difficult time. And it led to divorce between me and my wife. All very amicable. I think she did the right thing, which was to decide that she'd had enough, and she didn't really see PensionCraft as a useful thing. I think it was very difficult for her and her parents to understand a business model where you give away 95% of what you do for free. I mean, that sounds crazy, right? I mean, how could you possibly make money out of that? And of course, at the time I wasn't, but I knew that if I stuck with it, that ultimately I'd gain a following and people would find the knowledge valuable, because I knew I was putting everything into it. I was literally pouring myself into these videos. So I knew that it was valuable, because I knew at the bank people found it valuable who were professional investors. So it was just a matter of time. Ultimately, I was hoping that until people discovered that it was useful.
Let's drill in there, because it's during our most challenging times that we get our greatest insights. Because if we stack them up, I mean, you left probably a well-paying job with the bank, and yes, you've got the parachute of the payout, but that's a bit of a panacea at times, because it's still, as you say, it's not putting bread and butter on the table week to week. You're then spreading yourself between tutoring and building PensionCraft. It sounds like you had a lot of doubters around you who were, I'm not being deflammatory to your wife or family, but it's quite normal for people who are used to a regular income check to suddenly see a position where there's nothing and they can't see anything coming. You see you giving all this stuff away, but the payday doesn't appear to ever be coming. How did you maintain the fortitude and the self-belief? And then there's a divorce thrown into that, so there's all of that sort of comes back to you questioning yourself. How did you manage to manage yourself through that process and stay focused on the vision of what you're now doing, despite that quite deep opposition from a whole series of corners, Ramin?
Well, I was a member of something called the Content Marketing Academy, run by a guy called Chris Marr, who is a Scottish man, and he was really a good teacher. Ultimately, his business didn't survive, but he provided teaching on how to do content marketing. Because my background was physics and banking, so I didn't know about marketing. So for me, this was a complete eye-opener to know that, yeah, you can give away stuff and still ultimately make a profit, but you've got to keep doing it. That was the gist of it. So I had an accountability group which formed as part of that, and there are 4 of us, and we still meet every 2 weeks, and we discuss our businesses, but we discuss life. So they saw me through the divorce. They were the ones that said keep going. And if I hadn't done that, then I wouldn't be where I am today, which is a business which works and feeds me and feeds Laura and feeds my dog, Teddy, and ultimately it'll feed several people, I suspect. That's the goal. So I think that what really is important is to have that kind of accountability group who understand your business, you understand each other, and you support each other. Because if you don't keep going, then obviously you're not going to succeed. Now, there obviously does come a time when you realize that it's not going to work out. And it's difficult to draw the line. It's difficult to know when that point is. And for me, I came very, very close. There was a point at which I just said, look, if it doesn't work in the next couple of months, I'm just going to give up. And I think at that point, I said, well, what I'm going to do is I'm going to create a Patreon account. And then one of the accountability groups said, don't forget to say at the end of the video, sign up on Patreon. And I thought, oh yeah, why don't I do that? And guess what? When I said sign up for Patreon, people did. And so that grew very rapidly. So that was effectively how I kept going. And then once you start to see the Patreon numbers build up, then you realize, yeah, this is something that could be a viable business. And now we've got, over 700 members, almost 800 on Patreon, and 80,000 subscribers on YouTube, almost 90,000, and it's growing very rapidly, and a mailing list with over 10,000 people. So it certainly succeeded in the end, but it was really touch and go for a long time.
Yeah, it's a living example there to me of the patience, persistence, and endurance and resilience you need to succeed in anything. And it's often, when you're about to give up, that the turning corner or the opportunity that's going to carry you long term is sitting there. So it's admirable that you've been able to stick with it and maintain yourself with that accountability support group that sits in around you to see it through. So congratulations on that, because I often say to people that are contemplating being self-employed, if you can't survive for 2 years on nothing, then probably don't start, because that's about the minimum you need to even get to a point where you're going to start to put some money on the table. So,
yeah, it was almost exactly 2 years before it did take off. So I think that's about right. I'd heard 1.5 years, and then at the 1.5 year point was my kind of crunch moment, and so that was important to keep going after that.
Yeah, brilliant. So excellent. So what I'd love to do now, though, is to jump a little bit. Before I do that, I'm going to go in a different direction. While you were building your career and the family and everything else, I'd love for you to share with us what, if anything, you were personally investing in along that journey, and why.
So when I was at the investment bank, I was very time poor. So for me, I had very little time to think about investments. So I just put it into some fairly random investments. It was a high yield bond fund, because I was working in credit, so I had a fairly good knowledge of how that worked, and a European equity fund, and I think there was an investment grade corporate bond fund. So those were the kind of things I put into my ISA, and I just left it. I never even looked at it, and that actually did very well because I ignored it. I didn't do anything with it, and I kind of learnt my lesson previously, because I tried trading single stocks when I was just getting into investing in the first instance before I went to the bank. So I used to try and invest in single stocks. I read a couple of books, and it just imploded, and I did all the wrong things, and I made some terrible investments. But then I kind of learnt from that and just kept it simple. And that worked fairly well because I didn't do anything with the portfolio. So that was a good way to invest.
Well, and
I didn't really realize at that point. I still didn't realize that was the kind of secret, which was the fact I'd ignored it.
And let's spell that secret out, because this is something that I don't see many investors in many areas all get, because there's always this perception that we've got to be very active to produce results. It's almost written into our culture, I think. Australians are predominantly, much more cosmopolitan now, but there's a lot of British heritage in the way we operate, think and behave here in Australia. And I'm a proud convict myself, actually, Ramin, if we track the heritage back far enough. But what goes with that is this: got to be doing it, got to be active, got to be making it happen. Whereas, if we tease out what you've just shared with us, your best performing investment was the one you didn't do anything with. You just set and forget. Can you sort of sum that up for us a little bit? Because I think there's some real gold in what you've just mentioned there.
Yeah, the first time I really realised how important that message was a story that I'd heard from Jim O'Shaughnessy, who's written a brilliant book called What Works on Wall Street. So he's a kind of quant investor, an incredibly funny guy. He has the best memes on Twitter. He's really great on FinTwit, but he's really generous with his time. He spends a lot of time mentoring people and sharing his knowledge. A lot of stuff about philosophy, but also about if you listen to his podcast, it's very good. It's called Infinite Loops, where he talks about things like philosophy and things which you wouldn't have thought would be related to investment. So one of the things that he actually shared with me was I'd heard this story that Fidelity had done a study to see which of their clients performed the best. And it turned out it was the dead clients, these people who'd created a trust and who basically didn't fiddle with the portfolio, and their portfolios just blew all the others out of the water. So I'd heard that it was Jim that came up with this anecdote, and he confirmed that he'd heard it from someone at Fidelity. They never found the original reference, but I think the idea is a good one, which is don't fiddle. The ideal investor is a dead investor. So if you can pretend to be dead, then that's a good way to do it. So in fact, that's why I call it the kind of Teddy investment approach. So you can see how Teddy spends most of his time.
For the listeners who aren't watching this, Ramin's beautiful dog is spread-eagled on the couch directly behind him. So,
But Teddy would make a great investor because, he has short bouts of intense activity interspersed with long periods of sleeping on the sofa. So I think that's probably the best approach to investing, because there are certain times when you get these incredible opportunities, when equity markets sell off and there's a big crash and everyone's saying don't invest, or there's just indifference about the equity market. And then you get these periods like now when, your plumber's telling you to buy Tesla, and that tells you that something's not quite right and things are probably overpriced. So I think having a sensitivity to that, and you having these periods of intense activity when you capitalize on the opportunities is important. And then having long periods of doing nothing is absolutely okay. And keeping FOMO at bay, this fear of missing out, which makes people desperate to invest. So I speak to quite a lot of high net worth investors now, and many of them are in a position where they've sold a business, they've got millions to invest, and it's in cash. And they feel bad about it because they think, well, I should be fully invested. All these investment banks are coming up to me, very kindly offering to invest my money for me. And I just tell them, look, you don't need the money and there's no rush to invest. Take your time, because you can afford to invest when things are much better in terms of an entry point, when prices are low.
Yes.
So I think that fear of missing out forces us to kind of try and fiddle.
Yeah, it does. I agree 100%. And I know you're ascribed to some of Warren Buffett's philosophies as well, but one of his best, I think, is to spend a lot of time with the bat ready to hit the ball, but until the perfect ball comes along, you don't swing. So it's a pretty good analogy, I think. Tell me, you sort of touched on a little bit, but I'd love for you to share with us what you believe has been your worst investment ever so far, Ramin.
So I had some awful ones, I've got to say. And I think probably the worst, and this one has all of the cognitive biases built into it. So these are the kind of things you should avoid. So this was when I bought Wyvale Garden Centres. I love gardening, right? So I love gardening. I think I understand it. And in the UK, it's really big. People every spring, they go out and they buy lots of stuff for the garden. And it's, millions of gardeners in the UK. So it's really a kind of little bit of paradise in your back garden that everyone tries to construct. So I thought, well, we've got all these gardeners. A great investment would be something like this company called Wyvale Garden Centres. So, I go and I buy large quantities of this stock. So I was too concentrated. That's my first mistake. The second thing is, it comes springtime. It rained on Bank Holiday Monday. The sales of these companies depend hugely on that bank holiday, and the share price tanks. And so what do? Do I hold on? No, I sold just after it crashed. So I bought at the peak, I sold at the bottom, and obviously, I'd kind of locked myself out of it. And guess what happened? It rallied straight away. So I was locked out of the investment, and I'd done all the things which I shouldn't do. I'd gone for a sector where I'm familiar with it. So that was kind of like a familiarity bias.
Yeah.
I'd hugely concentrated my portfolio. I mean, single stock stuff generally doesn't work. And then I sold when it fell, which is exactly what you shouldn't do. And I bought at the top. So, I mean, literally, it was a disaster. But that taught me that actually funds might be a better way to go, where it comes off the shelf as a portfolio which is diversified. It's fairly cheap. The management costs are low, and you don't have to think about things like rebalancing or any of that stuff. It's all done for you. So that's, I think, how I first came to realize that was maybe not going to work for me. But I had read a few books and I thought, look, I've got all this data. I can look at the earnings growth historically. I can look at the price to earnings growth ratio, and all these ratios I looked at, the dividend. But in fact, it was just a foolish game, and it was a game I was going to lose. And I think that's the important thing. Not everyone has the best, there isn't a single approach to investing. There are multiple paths to a good portfolio. So one of the things at PensionCraft is that I never tell people what to do. I just present the data, and I always try and present both sides of an argument for and against an investment. And ultimately, people have to find their own way. And everyone has their own style of investing. So some of the pension crafters, usually the younger ones, are heavily invested in crypto, which is fine if you understand the risks of that and you're kind of happy with the investment itself. Whereas some of the older people invest more in things like venture capital trusts, where you're funding startup companies, or they invest in Russia or emerging markets, or some of them just have a single fund. That's it, and they keep it really simple. So there is no one size fits all, and I think it's important to have that diversity in the community. But we're all nice to each other, but you can see the friction sometimes on the Slack group where we talk to each other, where there's a kind of clash of cultures, but we're always polite. Well, we're usually polite to each other. We try and keep it polite, but I think that's important. There isn't just one way to do it. And I think that's why copying Warren Buffett or copying me is a mistake. And people always ask me, how do you invest? And tell me what to do. But I never do, because that's not my goal. My goal is to teach you how to do it for yourself in your style.
Yeah, and you touched on a really important point there, because all of the fundamental, whether you're technical or you're a quant, or whether you're a value investor, or whether you're looking at fundamentals, the missing piece, or the bit that's unique about all of that, is how you think. Because how you think and then how you act are going to have a big impact on the sorts of results you're going to get from your investing. And I think I'm interested in your thoughts around this, but the missing piece that I see in a lot of investors is that they spend all the time externally looking at what's going to happen. They spend very little time thinking about how they think and what's between the ears, and what impact that's going to have on their own behaviours. What's your thoughts around that?
Yeah, I mean, it was an interesting thread on PensionCraft recently, where one of the old timers on in our community said, "What do you think is the biggest risk for your portfolio?" And I said, the biggest risk is you, because your behavior ultimately determines how much money you'll make. And if you have the wrong kinds of behavior, then it'll be a disaster. So I think that's the single biggest risk. And I think people talk about understanding things like volatility and correlation. I talk about it. But much more important is to understand your own psychology. So I think it's really important to understand it and to master your own behavior and to overcome your own cognitive biases, whatever those are. And we all have them. We're very ill-suited to being investors. If we sense a sell-off, our natural reaction is to run away from it and to take risk off the table, when you should actually be running towards the fire. And of course, evolution has told us that you don't run towards fire. So you've almost got to be like a Marine. I mean, they drill Marines to run into enemy fire, and it takes a special kind of mindset to do that. And that's what it feels like. If you've got a big sell-off, like in 2008, and you have to buy in that carnage, you feel sick. I mean, literally, you feel sick, because you can see what's happening in markets. Every news story you read is saying that the world is ending and, the system's about to collapse. And it seems quite plausible that it will. But I think that's why it's important to know that that is not the case, that a lot of what people say is not true, and usually everything's okay. I think that's the important thing. Be an optimist, because ultimately these things do recover. If you invest in single stocks, sometimes those don't recover. But if you index, if you go for indices, like a whole market or funds, then ultimately they do recover. If you have a diversified portfolio, again, it has to have certain caveats. But that's the important message, I think.
Yeah, I think one that sort of goes parallel with that is that a lot of investors believe they need to create a job for themselves effectively. They're not recognising at the time, but they need to put that amount of energy in it. coming back to your debt investor analogy, which I think is a really good one, which I'm going to use. Thank you, Ramin. If you get active early and do your homework and do your due diligence and get into something that's diversified and it's going to follow the general direction of the market, providing we all still believe that it's generally going to go up, then the best thing you can do from there is get the hell out of the way. And for me, I often say, if an investment is creating a job for me, it's not an investment. That's not an investment. That's a job. What I actually want to do is my investments to fund my lifestyle, so I can put my energy into the things I actually enjoy doing outside of that, and just monitor it, sure, but not have to be so active in it that it's actually replacing my employment income with the time I need to spend managing, monitoring the investments. What's your view on that side of things?
Yeah, absolutely. I think that really you shouldn't be spending too much time on investment. There are certain periods of time when you should be focusing on what's going on, and those are the big sell-offs. That's when nobody else wants to be involved. Those are the real opportunities. Yeah. But most of the time you should just be fairly hands-off and just get on with your life. Enjoy the stuff that you do, spend time with your family, do whatever it is that makes you happy. And as you say, I don't think investment is a job. And I think you should have realistic expectations about investment. Investment doesn't make you rich. Investment keeps you rich. And ultimately, it takes a long time. And it should be boring, right? So if people say, well, I'm really excited about this trade, then immediately that's a red flag for me. It should be really boring, like taking out the rubbish or washing up the dishes. It should be just something that you do as part of your routine.
Yeah, absolutely great. Yeah, awesome advice. What I'd love to do now is jump briefly into the future for a minute, and then I want to drill into some mutual topics of interest. So I'd love you to paint out a picture of what your ideal lifestyle is, and make that as vivid as you possibly can for us, and then talk to us about what you have invested in and what you will invest in to either make that happen or continue to allow that to happen.
Yeah, so for me, an ideal lifestyle is a fairly simple one. I mean, I don't particularly want to live in Monaco or have a fancy car. So for me, having a fairly simple life, but, comfortable. I like gardening. I love my dog. My partner, Laura, we obviously we want to go on things like holidays and not spend all of our time working. So, I mean, when I first started PensionCraft, it was literally 24 hours a day, 7 days a week, doing this and the tutoring. But now what actually Laura's helped me do is to map out time at the weekends. So, we go and see friends and we relax, we do some cooking together. Personally, I really like to go for walks with Ted, my dog, and have time to do that, which I'd never had time to do before. So I think having that time when you can kind of recover and live your life, as well as do the interesting stuff, which I really enjoy, which is the PensionCraft teaching and the business side of things. I think having that balance is very important. As you say, I think that's one of your threefold approaches to life, the three things which are important.
Yeah, spot on. No, that's a really good analogy. And in terms of your investment approach now that's going to continue to create and then fund that ongoing lifestyle, what are you, again, we're not asking you to get into the nitty-gritties of this, but your investing approach, how has that evolved and what are you doing personally in that regard?
Well, this is why I always say don't copy me, because not everyone else has got a startup business who's my age with my medical conditions or whatever it is that worries you. So I'd say up to the point where I left the investment bank, there was just that portfolio which I'd left for a long time. And then once I started PensionCraft, I opened up a Vanguard account, and I've been generally very cautious in that account since it's opened. So the reason for that is that I've got a fixed amount of capital, and if I lost it, that was it. There was no second bite of the cherry. And I didn't know I was going to have enough money to live until quite recently. So for me, it was very important to be cautious. So I've had a very cautious portfolio, a lot of fixed income in it. And Vanguard has closed my only equity fund. So when valuations got to very high levels last year in February, I sold half of my equity. And then Vanguard shut down my remaining equity. They closed my fund in February. And so I've literally got no equity at all now.
Yeah.
So everything I've got is in bonds and cash. So what I'm going to gradually do over the next 2 years or so is average back into the equity market, because ultimately that's where you get the highest returns. And I'm still fairly young, and now I've got the ability to pay for my lifestyle. I don't depend on my investments. That's the important thing. You having investments that you depend on is a very different game from having investments which ultimately could let you retire. So now I'm being more risk on. So I'm putting more risk on the table, and I'm going to gradually build that up over time. And if there is a big equity market sell-off, then I'll accelerate my equity purchases and go all in. But if there isn't, then I'll just gradually build up to a mostly equity portfolio.
Yeah. Something I'd love you to touch on, because where Australia is perhaps a little bit different from the UK, Europe and the US, is that we are very tax advantaged in property here in Australia, and Australians have an absolute love for property. In fact, on average, the real estate represents about 54% of household wealth here in this country. And, property's certainly been very generous to myself and my wife over a long term. I know things are a bit different in the UK. What if any, part does property play in your thinking around investment, both now and in the future?
Well, in terms of wealth, the UK is exactly the same. About half of UK wealth is tied up in property. And many of the clients I speak to not only have a portfolio of standard market investments, they also have large buy-to-let portfolios. So we often have this discussion about which is most advantageous. And look, if you have property, then it can provide a good income. The other benefit is that it gives you leverage returns. So if you put a small amount in, obviously you can amplify your returns, but also your losses. That's obviously a risk. And it's very closely tied to GDP. That's the first problem, I'd say. So if you do have an economic downturn, generally that's a negative for house prices. And because of the fact it's very liquid, it's very difficult to sell, and it's costly to sell your property, then it can take a while to get out of that market. So if you need the money, then putting it in property is a bad idea. So only money that you can really leave on the table and untouched for decades, I'd say, would be suitable for the real estate market. Yeah. But it does provide you with that kind of income. And, the leverage can be attractive to some people. But obviously the house you live in is not an investment. It's a liability.
Yeah, beautiful. Yeah, and I'm glad you said that, because that's the conversation I had with people here when they come and say, well, I've got money in my house. Well, no, you haven't. That's costing you money, and it's not worth anything until you sell it, and then you've got to live somewhere. So don't kid me that your home is an investment, because that's a place where you live. So
and the other problem is you can't diversify it. So you can always buy real estate investment trusts. So that's commercial property wrapped up as a kind of equity, which allows you to diversify globally. And that's got sectors as well. So you can invest in things like data centers, or the area of land which is used for mobile phones, mobile phone masts. They have to sit on land somewhere. So the way they actually fund that is via real estate investment trusts. Or you can buy shopping centres, obviously not so good at the moment, or office space, again, not great at the moment. But these are the kind of things where obviously you'd buy it when it's stuffed, because that's when you get the reasonable valuation. So if you're kind of like, if you're somebody who wants to make the best possible profits, you'd buy those when they're depressed. But what's good about the REIT market is that it's very liquid. So literally you can sell these things in seconds. And it does provide an income as well. So that might be another way to get exposure to property, which isn't necessarily the case, which isn't necessarily as liquid as physical property that you buy as an individual investor. And also you don't have to fix somebody's boiler at 2 a.m, which is another aspect of real estate, which I'm sure you may have had to deal with.
No, we get other people to do that, mate. I'd say, that property is a game of finance, and it's also an elite team sport, and you're not a player. you just manage the managers, mate. So you make sure you've got better people to do that. So you're not getting up at 2:00 on Saturday night with a screwdriver to go out and fix the pipe that's just burst. Hey, I'd love to now dive into a subject that I know you've got some passion for, and it's something that I haven't really spoken too much about on the podcast today. And I'd like to really elaborate on this area, if you don't mind, and that's the importance of asset allocation. So I'd love you to take us through the key aspects of that, if you like, because I know you've got a really good course that revolves exactly around that. Can you sort of take us on the key things that need to be thought about so that the listeners can start to then understand how important asset allocation really is?
Now, we started off with this metaphor of animals, and understanding that a portfolio is kind of like a menagerie or a kind of petting zoo that you have to put together yourself. And all of the animals have to sit nicely together. And I think that's the way to understand asset allocation. What is the attribute of this asset type? So let's say it's equity. What are the drivers of equity? What makes the price go up and down? And then secondly, what kind of macroeconomic environment would be good for that asset? And the answers are often quite difficult to understand, and sometimes it's not clear cut. Some assets do well in a certain environment in one era, but they're not in the same environment in another era. So it's not as simple as just saying, well, interest rates are going down, so it's good for this or that. So, but broadly, it's understanding the attributes of the different asset types. What are they? So in the asset allocation course, we go through each of the different asset types, how to work out the risk of a portfolio, how to work out the correlation of the portfolio, and whether things diversify each other. So, for example, equity generally does well during periods of economic growth because earnings go up for companies, and if earnings go up, then the prices track them upwards. Sometimes earnings go up without prices tracking them if people are too glum, and sometimes prices go up even if earnings don't. So in 2019, earnings in the US were basically flat for 3 quarters, but equity markets kept on going up. And that's the point at which I sold. It was the 3rd quarter of earnings growth. And then obviously we had the pandemic and everything sold off. And I was quite pleased that I'd sold half of my equity at that point. So it's important to understand what drives each market. In equity, it's earnings growth. Prices ultimately track earnings growth. And in the fixed income space, there are a whole bunch of drivers. So for bonds, generally bonds feed on misery. So whereas equity does well during periods of happiness in the economy, the bonds feed on misery. So if there's bad economic news, if there's a disaster in the equity market, that's when bonds really thrive. And that's why they sit so nicely together, because when equities are selling off, you want something that's not going to sell off with it. And basically within equity, there's almost nothing which is a safe haven during one of these massive sell-offs. You've got to move to another asset class, which is fixed income. And the safest of safe asset classes is US Treasuries. And the other thing to understand about bonds is how long are you tying up your money? So if you're tying up your money for a long period of time, you're baking in a fixed rate of interest. If everyone else is earning more than you, if interest rates rise, well, that's terrible because you've locked in a low rate. So if interest rates rise, the price of bonds go down. Yeah. And if interest rates fall, the price of bonds go up. So that's another important thing to understand.
Yeah.
Central banks, the role of central banks is very important too. So they're the guys who determine the level of interest rates based on the economy. So a lot of the stuff I talk about on YouTube is what the Fed's going to do, because that really matters. And understanding what the Fed is saying is also really important, because you'll understand what's going on in markets much better if you understand that monetary policy. And I think a lot of people don't understand that. So that's another big part of what we teach. Yeah. And then we've got things like slightly more esoteric asset classes like commodities. I know people in Australia will be clued up to that particular asset type because that's essentially the lifeblood of growth. You have to, if you're building Beijing, you have to have concrete, you have to have rebar, you've got to have glass, steel. So understanding the drivers of commodities is much harder, I think, because it depends on things like mines being shut or demand being modified by economic slumps, whatever it is.
Yeah.
So I think these are the kind of broad ways of understanding what's the driver of the asset class, how is it correlated to the other assets that you've got, and do they diversify each other? And if they do, then they might sit well together in a portfolio. And then finally, what are the macroeconomic environments where those particular assets will do well? Just to give you a kind of broad overview of what you'd learn in the asset allocation class.
Yeah, brilliant. And if you were to sort of sum up the most successful asset allocation strategies that you've seen, and again, this is not financial advice, and we're not suggesting that the listeners rush out and do this, but what can you share in that regard?
Well, I think having a mix of equity and bonds, which is suitable to your risk appetite, is the most important thing. And to explain why, let me just tell you about what happened in March last year in 2020. Now, I'd gone blue in the face telling people that when equity markets sell off, you don't sell, you buy. Yeah. And people would all say, oh, yes, Ramin, I agree. I'd never do that. I'd never sell. You can bet 1 month after it happened, I started getting the calls saying, Ramin, I sold and now I'm locked out of the market and prices have gone up. And what am I going to do? So for many of those people, many of whom I'm still talking to now about that, we're talking about how to get back into the market. So, I think having an asset allocation which is suitable to your risk appetite, which means that you won't sell when equity markets fall, is really important. So let's say every 10 years or so, let's say equity markets fall 50% from their previous peak. If that's the case, then if your portfolio is 50% bonds, 50% equity, then you'll only take half of the hit. And that might make you less likely to sell.
Yeah.
So it's really about controlling your own ability to sleep at night. If you're somebody who doesn't like risk or doesn't want risk or doesn't need risk, then having less equity in your portfolio might make sense.
Yeah.
So I think that's important. The asset allocation, really the biggest choice is how much equity, how much bonds, and that level of risk. Because if you don't understand the risk, effectively you're just kind of shooting in the dark. You've got no idea what's going to happen to your portfolio. Yeah,
totally. Something that, and I bet you this is a question you're getting quite a bit of as well, is for those that haven't invested yet and are sitting in cash. Given there's a lot of talk about the emerging asset bubble and the correction / crash exercise. What do you say to them in terms of do I sit back in cash and wait for the correction and jump in, or do I just jump in anyway?
A lot of the people I speak to don't have a lump sum. So these are people who are regularly investing their salary, and for them, this is irrelevant, right? They can basically put their fingers in their ears and just carry on investing as much as they can, as much in equity as they can for a long period of time.
Yeah.
For the people who do have a large lump sum, it's a very different story. They're very nervous now because they see all the stories, they see the valuations sky high. Now, the justification for that until recently was that interest rates were low. So people could say, well, it's kind of understandable that valuations are at the highest they've ever been in many cases because interest rates are low. Well, they're not so low now because we've seen US Treasuries go from 0.8% to 1.7% over a handful of months.
Yeah.
So that justification can't be used anymore. So now they have to say, well, it's fiscal stimulus, which is creating this increase in equity prices, or this is a new paradigm, which is always a red flag. Or they say valuation doesn't matter anymore because in this new world, it doesn't matter whether a company is earning enough profits to justify its price. Now, when people say valuation doesn't matter, that's when you know valuation matters most of all. That's a sure sign that something's badly wrong.
Yep.
So for these clients, I usually say, well, I understand what you're saying, but you don't know how long the bubble's going to last. And in Japan, in the late 80s and early 90s, valuations went to double what they are now. So literally a price to earnings multiple of 60. or 50 to 60, I think it was. So you can't just stay out of the markets waiting for a crash. So you do have to allocate some capital, maybe not all of it, but some of it. And I think your portfolio really has to express your beliefs about probability. And you always have to allocate based on the most likely outcome. And if you always allocate in terms of tail risks, you'd never get out of bed. You know, if you worried about risks in the same way that people do in their daily lives, then you literally never get out of bed. You'd never drive your car. You'd never drink any alcohol. You know, you'd take no pleasure in life. So similarly for a portfolio, you've just got to say, well, I've got to take some risk. I'm not completely sure there's going to be a crash, so I'll have some equity, but maybe I won't allocate my whole 100% of my money into equity. So that's what I generally say. And you can always dollar cost average into markets, because then if there is a crash, this is what I'm doing. Then you can really fill your boots and go fully into equity.
Yeah, and again, that debt investor strategy, if you're just drip feeding little bits in regardless of what's happening in the market, and therefore timing and market swings is irrelevant, because you're focusing on the next 20 or 30 years, not the next 2 or 3 months, which is always the challenge. Tell me, you touched on crypto before. I'd love your thoughts on it, and I'm talking here from a investor perspective, not a speculator, because like a number of people that have been calling me saying, look, I'm going to sell my investment properties and put it all into crypto. I shake my head when I hear this sort of stuff. But I'd love your thoughts around crypto generally as a long-term investable vehicle, not a short-term speculation. What's your thoughts?
Well, like anything, the value of crypto depends on what people are willing to pay for it. Ultimately, that's true of any market. But the difference between crypto and other asset types is that it doesn't generate an income. And the reason why I don't invest in it is because of the difficulty of accessing the market. So if there was an ETF for crypto, I'd probably invest some of my portfolio in it, just a small percentage, because it does provide some diversification, because, it's not really tied to any other asset classes. And obviously the returns have been good recently, but it is a very crashy asset class. And what worries me is just as many people approach me after equity markets crashed because they bought at the top and they sold, it's so much worse for crypto because the crashes are so much bigger. And we haven't had a crash in it recently, but you just look back to 2018 and the crash was huge. So I think for many people, the cognitive biases are made that much worse by the volatility, which is around 80%. And the volatility still hasn't come down for things like Bitcoin. People said it would by now, but it hasn't. It still remains very high. So I think as long as you understand the risk and you understand the behavior, I don't have any issues with crypto as an investment. Yeah. Would I have it as a large percentage of my portfolio? Probably not, because I think you also got to think about what is the impact of the thing I own. So if I buy some equity tracker, effectively I'm providing capital for companies that provide goods and services. Yeah. Or if I buy a corporate bond fund, I'm funding these companies which provide the goods and services that we use every day. Whereas with crypto, all I'm really doing is paying for a number. Yeah, I'm paying for a key, and it also has a certain energy cost, which I don't like. So what's the net effect on the world? It doesn't have any practical use. As a transaction system, they're not great, in Bitcoin in particular. Other cryptos are better. But, I don't really see why the world is a better place because of it. Because I'm not paranoid about fiat currencies. I don't share that rather extreme worldview that fiat currencies are doomed. I just don't think that's true. And I think a lot of the narrative you hear on YouTube, which is that fiat currencies will become worthless because they're being printed to oblivion, I think that's just nonsense. And I think that's very misleading. So what I don't like about it is that kind of religious aspect where you stop thinking. And if you speak to Bitcoin people, you realize it is like a religion. they'll tell you about it day and night, and they just tweet about it, and they're really quite boring, unfortunately. So that's why I don't like it, because I don't like the religious aspect.
Well, and it's become I love your thoughts on this, and maybe I'm just more aware of it now, but the perceived story that's sold around crypto, and we're seeing the same with the whole GameStop Reddit herd mentality. It's all about the story, and there's this disconnect between what the thing's doing and what people believe it's worth. What's your views on that? Is that a trend that you're seeing? I mean, you've been more active and involved for a lot longer in the markets globally than I have.
I mean, for example, GameStop, everyone is kind of selling that as sticking it to the big guy, the guys in suits. Yeah. But if you look at trading volume, what makes the guy at the investment bank able to have a Lamborghini? It's because there's trade flow. And the more trades there are, the more money they make. Now, trading flow had actually been going down for a long time until GameStop, until we got this massive pandemania, this incredible rally that we got in equity markets after March in 2020.
Yeah.
And because of that huge increase in flow, there's been a huge increase in profits at investment banks. So really what GameStop and the so-called democratization of investment has done is it's made bankers richer. If you trade a lot, you're just giving your money away to an investment bank. You're paying for their Lambo. So that's probably not the intended consequence. It's not really having the effect that people think it is. And really making a company like GameStop, which is a broken business model, increasing the price of the equity is not an efficient use of capital, ultimately. It's a company that shouldn't be allowed to thrive because what they're doing is no longer kind of relevant. Why would you buy games from a game store in a shopping mall when you can stream stuff now or you can buy online? I think that's a mistake. So I think that's a good example of an unintended consequence.
Yeah, well, it's like the old zombie companies back in the Japanese exercise where things have been kept alive. If we use the medical analogy, we're using the electric shocks to keep the body alive, but the brain's dead. It's actually gone. And when we start to see that level of perception driving, and same in crypto, it's the old greater fool approach. As long as there's a greater fool that's going to pay more than I'll keep jumping in. But there's no other justification for it other than that, pretty much.
And Japan's an interesting example, actually. If you look at the amount of retail investors, this is normal investors, involved in generating the flow of business in the equity market, a lot of the trades were done by retail investors during the bubble. But then after the bubble popped and nobody was interested in equity anymore, except for some big institutional players, the amount of retail investment dropped dramatically. And I suspect what we'll see is maybe not falling back to levels that they were at before, but a lot of the people who are new to the market will see after the next correction, which is ultimately going to happen, there'll be less interest. And I think a lot of that flow will kind of go away. As people also realize that the best way to invest is not to trade a lot. And they're going to have less time on their hands because they won't be stuck at home once the lockdowns end.
Exactly right. And let's just touch on that because that's something that I know you've spoken about quite a bit in the past. And it's a thing that not a lot of investors really get their head around, and that's the effect of fees on investment returns. Can you just expand on that subject for us?
Yeah, there was a really great talk which I heard by a Canadian guy called Larry Bates, who he creates something called a T-Rex calculator. So T-Rex. And if you just look for Larry Bates T-Rex on Google, you'll find his calculator. But effectively what you do is you tell this calculator, how much am I investing? What will my return be? Say 6%. How long am I investing for? 10 years. And what's the fee I'm paying? So let's say returns are 6% and you're paying 2% in fees. Well, you'll get a pretty good return over that 10-year period because of compounding. But if you're paying 2% of it away every year, then you're giving away a third of your gains. So what the T-Rex calculator works out is what percentage of the gains you keep. The analogy I always think of when I'm thinking about this is, imagine you're feeding pigs, right? You're one of the snouts in the trough, but it's like your broker is one of the other pigs, and he's got a really big snout and he's eating some of your returns. And then you've got your platform eating some of your returns, and then your fund manager. So the idea is to have less snouts in the trough, because that way you get to keep more of the returns. And that's what the T-Rex calculator does. It works out the percentage you keep. So reasonably now you can trade with a fund that costs you 0.2%. You can buy global equity for 0.2%. Your platform, depending on how much you invest, will be roughly 0.2% again. So your all-in fee every year should be about 0.4. So that's a very small snout, and you get to eat more of the return. So I think that's the key thing, having the least number of people between you and the assets which generate your returns. And it's really simple.
And then the least amount of churn, so you're not sort of buying and selling all the time, or moving in and out unnecessarily, and you put those two together and then get the hell out of the way and let time do its work. I think that sums it up. And I love that pig analogy, the big snouts in the trough. I love the way you keep bringing it back to that David Attenborough
animal investing.
Now, something else I just want to sort of close on before we get into the Ambush series. You've written a great book called Investing in Fear, and it's one thing that permeates every aspect of every level of media these days, Ramin, because I'm going to sort of display my hand here. I think a lot of the media needs fear to engage our eyeballs and our earbuds to keep us watching. I'd love for you to talk about your book, Investing in Fear, and what are some of the key take-homes that might be relevant to the listeners on that one.
Well, I knew that lots of people were investing in volatility. So, it's something we used to talk about at the investment bank, and we obviously had to understand volatility. But it sounds like it's just like if you're at school and you were working out how much something changes over time, that's called the standard deviation. So it's literally as if you're trading the amount of wiggliness in a stock. So that's what volatility is, and you can actually buy and sell it. But what I'd heard was from clients that there were grannies buying volatility products and betting on whether the level of VIX, which is called the fear index, whether it would go up or down. So I thought, well, surely they don't understand the product, because it is quite complex, because you can't actually buy the VIX directly. You have to buy futures on the VIX, and that in turn has a carry cost. So all the time that you hold the product, it's losing money unless fear spikes. So the whole book is teaching you about when it kind of makes sense and how to get exposure to that volatility. So how do you minimize your carry cost? There are certain products which do that. So the rent you pay while you wait for a crisis to happen is smaller. And then secondly, once one of these crises do happen, can you buy a product that will make money as the price of VIX falls? And what's the best way to do that? What's the best level of VIX to get in and out? And it turns out you can't really predict the spike upwards, but the spike, or the kind of falling down of the volatility afterwards, is more predictable. So I think that's probably the better way to play it. And if you are going to go for a long-term volatility exposure as part of your portfolio, it's best to go for one of these products which minimize the kind of roll cost, which is the price you pay to hold it. But that's the goal of the book, to try and explain how these costs and strategies might work in a portfolio practically.
Yeah, and I love it. And again, I think that fear increasingly is going to play a big part in every aspect of our lives, given the focus of all forms of media on that very thing. And as a hedge, sort of embracing that as an opportunity rather than as a threat is something that I haven't seen anyone else put any energy into. So I'm going to jump into the ambush round if I can, Ramin, which are just 5 quick questions that the listeners always love to glean your words of wisdom on. And the first of those is, what's your favourite quote and why?
I think it's probably one by Warren Buffett, which is, when the tide goes out, you can see who's swimming naked. Because at the moment, that's what's happening, right? We're seeing lots of scandals unearthed, and the tide's gone out.
Yeah, no doubt about that. The top, other than your own books, what's the top book that you'd recommend listeners read and why?
It's probably Morgan Housel's book, which is The Psychology of Investing, or The Psychology of Money by Morgan Housel, because I think that touches on this theme of how to control your own behavior when it comes to investing, which I think is probably the most important thing.
Yeah, absolutely great. Now, this one's a little bit left field, but most Aussies feel like they pay way too much tax. What's the top and legal thing that you've done to minimise the tax that you pay?
Earning less. I used to pay a fortune in tax, and then I left investment banking, and now I pay very little.
That's an easy solution, and running your own business is also a very good way to do it as well.
Indeed.
Yeah, but back on the investment advice, I want to cover off on both ends of the spectrum here. What's both the worst investment advice you've ever received and the best investment advice you've ever received?
I think the worst was to buy gold. And it was actually from one of my strategist friends at the bank, who was the gold strategist, the precious metals strategist. And my mistake was to believe them and that they knew what the hell they were talking about. So that was an awkward moment. Sorry, Adele. And then the best advice, I think, probably was the fact that it was probably that Jim O'Shaughnessy thing, which is the best investor is a dead investor. That really caught my attention and made me realize the best behavior. Yeah. That's
such a good analogy. I actually haven't heard that before, and I'm going to use that, Ramin. So, because it says it all. It's if you just allow time and the markets to do their work, then that's providing you've done the right thing, diversified yourself early on. And I think, correct me if I'm wrong, but I think Buffett has said that once he passes, he's suggesting his wife just put money into a good Vanguard index and set and forget, get out of the road.
Yeah, that's right. An S&P 500 fund, a little bit into treasuries, and that's it. So if the best stock selector in the planet thinks that's the best thing to do, that's good enough for me.
Yeah, likewise. Last one, what's a personal habit or a rewarding ritual that you believe contributes most to your investment success today?
I think learning about investment is probably the best thing because even though it initially leads people to make complex portfolios, ultimately it makes them create simple portfolios. And usually I just have 2 funds in my portfolio. So I think understanding how to invest is probably the most important thing, is that continual learning. And I'm still learning. When I make courses, when I make videos, that process should never end because things are always changing. Yeah, spot on. Final question, and it's a big one, but it gives you an opportunity to wrap all this up neatly. If I gave you a microphone that spoke to every single one of the 7.7 billion odd people that are currently alive in the world, and I gave you 1 minute to talk, what would you suggest they invest in? So firstly, I'd say have a plan. Don't just buy stuff willy-nilly. What I see a lot of the time is people end up with a portfolio like an accretion disk around a black hole where it just basically sucks in all these different trades and products. Keep it simple. You literally just need a couple of funds and you're done. The second thing is know what your goals are. Some people want to have a champagne lifestyle. Some people want a simple lifestyle. But if you know what your goal is, you can build your portfolio to fit that goal. Learn about yourself. That's as important as learning about markets. And keep less snouts in the trough. So don't pay too much in order to have those investments. Pay as little in fees as possible and basically have fun with it. But I'd say keep it as simple as possible. And if you do want to have a little speculative bet for fun, make it a small proportion of the portfolio, not a big allocation.
Yeah, beautifully said. Now, for those that have enjoyed our conversation as much as I have and want to reach out to you and do some more with you, Ramin, how can they do that?
Well, just watch our YouTube channel. Just go to YouTube and look for PensionCraft, and you'll see links to the stuff that we provide, the membership. You can support us on YouTube, or you can also sign up for our newsletter, which is free. So that's what we offer. YouTube's a good place to start. Yeah, awesome. Look, you've been very generous with your time. I know it's very early in the morning there in the UK, and you've got the hot cuppa to keep you company. But really enjoyed the opportunity. I've been getting a lot of value out of your YouTube segments for quite some time now, and that was what really sparked my interest to get you on, because I want many more Australians to be tuning into the sort of ancient wisdom almost that you're sharing there, that's giving them impartial advice that they often can't get from anywhere else. Everyone else has got a vested interest in trying to push them in a certain direction. What I love about what you're doing is you're giving them the information that then allows them to make more informed decisions based on what suits them. So very appreciative and looking forward to staying in touch as you continue to grow and prosper. Thanks, Ramin. Thanks for a great interview. I really enjoyed that. Thank you, Bushy.
Thank you, Ramin. Talk soon.
Get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die